What if I told you there's a way to potentially retire by 30 using a strategy that doesn't require you to time the market or constantly buy and sell stocks? In this video, we're breaking down the power of dividend investing and how it can fast-track your path to financial freedom. Imagine building a portfolio that pays you every single month, creating a steady stream of passive income. That's the beauty of dividend investing. Instead of waiting until you're 65 to enjoy retirement, you could be sipping cocktails on a beach in your 30s, all thanks to smart dividend strategies. Now, I know what you're thinking. This sounds too good to be true. But stick with me, because I'm going to show you exactly how dividend stocks can supercharge your wealth-building journey. We'll cover everything from picking the right stocks to reinvesting your dividends for maximum growth. By the end of this video, you'll have a clear roadmap to potentially retire decades earlier than your peers. Let's get started on your path to financial independence. All right, so you're probably wondering, how exactly can dividend stocks help me retire by 30? Well, let's break down the basics of dividend investing and why it's such a powerful wealth-building strategy. At its core, dividend investing is all about buying stocks in companies that regularly pay out a portion of their profits to shareholders. These payments, called dividends, give you a steady stream of income on top of any potential gains from the stock price going up. It's like owning a piece of a business that sends you a check every few months just for being a shareholder. Now, here's where it gets really interesting. Dividend investing actually offers you two ways to grow your wealth. First, you've got that regular income from dividend payments. Second, you can benefit from capital appreciation as the stock price increases over time. This combo can lead to some seriously impressive returns in the long run. But don't just take my word for it. According to The Motley Fool, dividend stocks have historically outperformed the S&P 500 with less volatility. That means you could potentially see better returns with less risk compared to the overall stock market. Pretty sweet deal, right? Now, I know what some of you are thinking. That sounds great, but I don't have a ton of money to invest. Here's the good news. You don't need a fortune to get started with dividend investing. Thanks to online brokerages and dividend-focused funds, you can begin with whatever amount you're comfortable with. Every journey starts with a single step, and the same goes for building your dividend portfolio. But wait, there's more. I've always wanted to say that. Dividend investing also comes with some nice tax perks. Most dividends are considered qualified, which means they're taxed at lower rates than your regular income. Depending on your tax bracket, you could pay anywhere from 0% to 20% on qualified dividends compared to the 10% to 37% you might pay on ordinary income. That's more money staying in your pocket and less going to Uncle Sam. Just keep in mind that some dividend-paying investments like REITs and MLPs have different tax rules, but for most dividend stocks, you're looking at a pretty tax-efficient way to generate income and build wealth. So there you have it. The basics of dividend investing, and why it could be your ticket to financial freedom. In the next section, we'll dive into how to actually build a dividend portfolio that can potentially set you up for early retirement. Trust me, you won't want to miss this. All right, so you're ready to start building your dividend portfolio for early retirement. But how do you choose the right stocks? It's not as simple as picking the ones with the highest yields. In fact, that's a common mistake many new investors make. Let's break down some key strategies for selecting the best dividend stocks. First and foremost, you want to focus on companies with a solid financial foundation and a history of consistently increasing their dividends. It's not just about how much they're paying now, but their ability to keep growing those payments over time. When evaluating potential dividend stocks, there are two main metrics you'll want to look at: dividend yield and dividend growth history. Now, you might be tempted to go for the highest yield, but here's a word of caution from the experts. Inexperienced dividend investors often make the mistake of buying stocks with the highest dividend yields. While high-yield stocks aren't bad, high yields can be the result of a stock's price falling due to the risk of the dividend being cut. That's called a dividend yield trap. So instead of fixating on current yield, focus more on companies that have consistently increased their dividends over time. These are the real gems in the dividend investing world. Let me give you a couple of examples of reliable dividend stocks. Companies like Procter & Gamble and Lowe's have increased their dividends for more than 50 consecutive years. That's some serious commitment to shareholder returns. These companies belong to an elite group known as the Dividend Kings. Now, once you've started building your portfolio, there's a powerful tool you can use to supercharge your returns: dividend reinvestment plans, or DRIPs. These plans automatically reinvest your dividend payments back into shares of the company without any fees or commissions. It's like putting your dividend growth on autopilot. But what if you're looking for even higher yields? That's where closed-end funds, or CEFs, come into play. These are a type of mutual fund that can offer some seriously juicy dividend yields. For instance, some CEFs like the Eaton Vance Tax-Managed Global Buy Right Opportunities Fund yield up to 7.9%, while others like the Gabelli Equity Trust offer an impressive 8.7% yield. Remember, building a solid dividend portfolio takes time and research. But with these strategies in your toolbox, you're well on your way to creating a passive income stream that could help you retire decades earlier than you ever thought possible. Now that we've covered the basics of building your dividend portfolio, let's talk about how to really kick things into high gear. I'm going to show you some strategies to accelerate your journey to retirement at 30. Trust me, this is where the magic happens. First up, let's talk about the power of compound interest and dividend reinvestment. This is like adding rocket fuel to your investment strategy. When you reinvest your dividends, you're essentially buying more shares of the company, which in turn generate even more dividends. It's a snowball effect that can seriously boost your returns over time. But here's the thing. To really make this work, you need to start early and stay consistent. The longer you give your investments to grow and compound, the more impressive your results will be. It's not just about how much you invest, but how long you let it grow. Now let's talk about maximizing your dividend income. While it might be tempting to chase after the highest yields, that's not always the smartest move. Instead, focus on companies with a strong history of dividend growth. These are the companies that have consistently increased their dividends year after year. They might not have the highest yield right now, but they're more likely to provide a reliable and growing income stream in the long run. Of course, no investment strategy is without risk. That's why diversification is key. By spreading your investments across different sectors and companies, you can help manage the risks associated with dividend investing. Think of it as not putting all your eggs in one basket. Now, let's get to the exciting part: creating a sustainable withdrawal plan for early retirement. This is where we figure out how much income you'll need and how to generate it from your dividend portfolio. Here's a real-world example. A portfolio yielding 7% can generate $38,000 annually from a $500K investment. That's the kind of passive income that could potentially fund an early retirement. One way to achieve these high yields is through closed-end funds, or CFs. For example, the Eaton Vance Tax-Managed Global Buy Right Opportunities Fund offers a 7.9% yield and provides diversification by combining U.S. and international stocks. These types of funds can be a great way to generate reliable income without needing to sell shares. Remember, the key to making all this work is starting early and staying consistent. The sooner you start building your dividend portfolio, the more time you give your investments to grow and compound. It's like planting a tree. The best time to start was 20 years ago, but the second best time is now. All right, now that we've covered the strategies to accelerate your journey to early retirement, let's wrap this up with a clear action plan. You've learned about the power of dividend investing, but knowledge without action won't get you to that beach in your 30s. So, here's your quick start guide to kick off your dividend investing journey. First, open a brokerage account if you haven't already. Many online platforms offer commission-free trades, making it easier than ever to start investing. Next, research and select a mix of dividend-paying stocks or funds. Remember, focus on companies with a history of consistent dividend growth, not just high yields. Start small if you need to, but start now. Even investing $100 a month can grow significantly over time thanks to compound interest. And don't forget to reinvest those dividends. Most brokers offer automatic dividend reinvestment plans, DRIPs, at no extra cost. To learn more about investing to build wealth, give this video a like and subscribe to the channel.